This meeting is being recorded.
Okay, this is going to be video number 4, and what I want to do in video number 4 is start chapter 4, which is our capital structure management chapter. So this is going to be largely built on the seminal work of Modigliani and Miller in 1958, that paper we've already mentioned. So we're going to begin, in fact, with the classical Modigliani-Miller arguments, and then we'll try to move to more practical and perhaps realistic considerations. So before I begin, I should say that I mean, for me, the first time I saw those arguments a long time ago, I thought they were beautiful. In fact, in many ways, I ended up choosing economics and finance because I thought, what a way to make a living to actually work on producing arguments like those. Now, let's be honest with each other. You know I'm going to butcher this because, that's what I do. But I just want you to know that when this is done right, this is some of the best stuff we have to offer in all of economics and finance. I've made the case on several occasions already that the Modigliani-Miller theorem, in my eyes, is one of the very, very most beautiful and important results in economics. The only competition really is the first welfare theorem, and I have this intuition that the two theorems kind of imply one another anyway, and one day I'm going to try to make that formal, that intuition formal. But anyway, it's good stuff, and hopefully I do it some justice in this video. Okay, very good. So what's the question? And why is Modigliani-Miller so important? So Modigliani-Miller asks a question which is obviously very important in corporate finance, which is, does the way in which a corporation finances itself matter for in the sense that does it change the value of the corporation itself? And to the extent that the financing mix and the capital structure have some impact on the value of the corporation, then a very good question to ask is, what is my optimal capital structure? So the general way to put this question is, does the value of an asset, any asset or collection of assets like a corporation, depend on the mix of debt and equity that is used to finance its purchase? And so what Modigliani and Miller proved in 1958 is that if you put yourself in the world of pure and perfect markets, so that means, for instance, you have no taxes, no transaction costs, no trading limits, no asymmetric information, no frictions whatsoever. The answer to that question is no. In other words, the answer in pure and perfect market is that capital structure does not matter. The value of the corporation is independent of the way it finances itself. What the value of the corporation, or the value, put it this way, that the size of the pie is independent of how you split the pie. How you finance yourself does not matter for value. Good. So then let us first prove this assertion that if we lived in pure and perfect markets, and again, we're lucky that we do not live in in a pure and perfect market environment, but if we did, capital structure would not matter. Let us prove this theorem. Let's prove the Modigliani-Miller theorem. So for that, we're going to move exactly to the setup of the 1958 paper. And so we're going to consider two corporations. And those two corporations have the exact same random cash flows, capital X. X is the notation that I believe Modigliani and Miller used, but for us, X is just EBIT. You remember, as we've already discussed this on several occasions, that Modigliani and Miller also assume that depreciation is equal to investment. So EBIT, if you happen to be an untaxed corporation, which in pure and perfect markets you have to be, because there cannot be taxes in pure and perfect markets. If you're an untaxed corporation, X is not just EBIT, but it's 1 minus tau EBIT, since tau is equal to 0, and since depreciation is equal to investment, X, put another way, is unlevered free cash flows to the firm. So we're going to consider two corporations that have the same unlevered FCFF forever. The corporation is going to live forever. And the two corporations are the same on the asset side, on the cash flow side, but they finance themselves very differently. Corporation number one is going to be levered. In other words, it's going to finance itself with a combination of equity E and debt D. And then so we have our fundamental accounting identity from chapter one that says that the value of the levered corporation, capital L, superscript, I'm sorry, L is going to stand for levered. So the value of the levered corporation is just the market value of equity plus the market value of debt. So as I said, we assume that the corporation lives forever and also that we keep the capital structure fixed. In other words, the quantity of debt is never going to change. And the way it is done in Modigliani and Miller, and in some sense, the way it has to be done is by assuming that debt is an interest-only perpetuity. In other words, you never repay any principal, you just have to pay some interest on the debt, and that's it. As I've mentioned already, L stands for leverage, so that's it. That's corporation number one. It's a levered corporation, a mix of debt and equity. Corporation number two is going to be 100% equity finance. And the value of that corporation, which is going to be the value of its equity, since it has no debt, is V upper U, where the subscript U here is going to stand for unlevered. Okay, that's it. So the Modigliani-Miller question is, can it be that VL and VU are different from one another? And again, this would say that capital structure matters because the two corporations are exactly the same on the asset side, but they have a different capital structure. So for instance, and we could do it the other way, can we have that the value of the levered corporation is bigger than the value of the unlevered corporation? So just because the corporation decided to take on some debt, it has become more valuable? And the answer, the Modigliani-Miller answer in pure and perfect market is no. This cannot be. And how are we going to prove this? Well, we're going to prove this using a contradiction argument. So let us assume, by way of contradiction, that we are in pure and perfect market, and yet we have that VL is bigger than VU. And we're going to derive a contradiction. And what is that contradiction going to be? That contradiction is going to be a deviation from the law of one price. We discussed the law of one price at length in chapter one, and you remember we did this for quite a while. We said in pure and perfect markets, it cannot be that there is a deviation from that law. So what does the law of one price say? It says that if you have two portfolios that give you the same cash flows in every time period and in every state of the world, in other words, no matter what, those two portfolios have to trade at the same price. The cost of the two portfolios have to be the same. Otherwise, as we proved in chapter one, there would be an unbounded arbitrage opportunity. And one of the aspects of pure and perfect markets is that I can take advantage of pure and unbounded arbitrage opportunities as much as I want. And obviously, the cost difference would be arbitraged away. So good. So that's the contradiction we look for. We assume by way of contradiction that VL is bigger than VU, and we're going to show that then I can build two portfolios that have exactly the same cash flows, but they don't have the same cost, and that cannot be. That's the contradiction that we were looking for. So what is my first portfolio? Just like in Modigliani and Miller, this is the exact and beautiful Modigliani and Miller argument. We're going to buy some fraction of the equity of the levered corporation. So what's the cost of doing so? Well, if I buy 10% of equity, the cost is going to be 10% times the market value of equity. That's what it's costing me. But what cash flow do I get forever with this corporation? Well, I get a fraction alpha of all cash flows to equity. What are cash flows to equity? They are my unlevered FCFF minus what I have to pay debt. Remember that debt is that there's no taxes in this environment, so we do not have to worry about paying taxes. So therefore, I get unlevered FCFF minus payments to debt. Those are interest-only payments in every period, and I get whatever fraction of the levered asset equity I bought. So that's it. That's portfolio number one. It costs me alpha E and it gives me this cash flow. Okay. What is portfolio number two? Well, I'm going to go out and borrow just like I can in pure and perfect markets, because in pure and perfect markets, I can do whatever I want. I can buy and sell whatever I want, no transaction cost. So I'm going to borrow a quantity of money, which is going to be exactly equal to alpha D. So if I bought 10% up here, what I'm going to borrow is 10% of the quantity of debt in the levered corporation. So that's a dollar amount. And at the same time, I'm going to buy a fraction alpha of the equity of the unlevered firm. So what is the cost of this portfolio? The cost of this portfolio is alpha times the market value of equity of the unlevered corporation. So that's the cost, but at the same time, I'm borrowing. So my net cost is going to be this. And remember, I'm borrowing using an interest only perpetuity. So this is a quantity of debt I'm never going to have to pay. But regardless, the date at the time when I'm doing this, the cost of getting into this portfolio is the cost of buying this equity minus the financing that I'm getting. And then I just put it together. And then this is where I use my contradiction premise. Remember, we started from the assumption that VL somehow is bigger than VU. Well, if VL is bigger than VU, then the cost of this first portfolio has to be less than alpha VL minus D, because VU is less than VL. But what is VL minus D? VL minus D is E. And so what we have here is that the cost of portfolio 2 is less than the cost of portfolio 1. And yet, the payoff of portfolio 2 is I have share alpha of the unlevered corporation. So I get alpha X, but then every period I have to pay interest RD on the quantity of debt that I took on. And this payoff here, the key, is the same as that payoff up there. So we have two portfolios. They have exactly the same payoff at every period, in every period and in every state of the world. They are identical. And yet the cost of portfolio 1 is higher than the cost of portfolio 2. This is a violation of the law of one price. That's the contradiction we were looking for. That cannot happen in pure and perfect markets, and therefore it cannot be that VL is higher than VU. And you can imagine that we could do exactly the same if we started from the assumption that VL was less than VU. And in any equilibrium in this environment, it has to be the case that VU is equal to VL. What does that mean? It means that the value of the unlevered corporation is exactly the same as the value of the levered corporation. Regardless of how much equity, how much debt you take on, it does not matter. The value of the corporation is dictated exactly by the asset side. The liability side in pure and perfect markets has no impact on the value of the corporation. Okay, so let's take a moment to step away from the math here and just put it in economic or at least finance terms, exactly what we've said so far. So why is it that borrowing for a corporation cannot create value? If you look at this argument here, basically what this is saying is I don't need the corporation to go out and borrow on my behalf. Why? Because I can do it myself. You see, any value that you create in pure and perfect markets as a corporation by borrowing is meaningless to me as the shareholder, because if I wanted to lever my equity investment, I could go out and borrow on my own. So this is the crux of the Modigliani-Miller argument. In pure and perfect markets, anything the corporation does, I cannot do myself. So therefore, your financing decisions cannot have an impact on me, on the value that I'm getting, because any financing decision you make, I can make just as well and at the same time. So beyond the fact that this enables us to prove the Modigliani-Miller theorem, this is also an argument that we want to remember, because this is always the answer to the question of should or should not a corporation take a step away from its core business to worry about the financing side of what it does. So let me give you a perfect related example of this. Let's assume that we have an international corporation that gets some of its income, or a significant fraction of its income, from overseas. The corporation, and in fact this is something you hear quite often, may say, you know what, I'm going to hedge that risk. I'm going to enter into some derivative contracts, which is going to protect my shareholders from the risk associated with the fact that I'm doing business in different currencies, in different markets, and the like. The question is that a good thing for the corporation to do? Well, on the one hand, this is something that has nothing to do with their core business. If they're selling carpets all over the world, they are not Wall Street traders, and it's not clear that we want them to think about how to build a portfolio that is financially optimal. So this is an argument against having corporations trying to do financing things on behalf of shareholders. But on the other, and that's got to be the only reasonable argument for engaging in those sort of financing strategies. It may be the case that the corporation has better access to financial markets. It may be the case that it is cheaper for the corporations to enter into hedging strategies, and therefore that they can do so better than shareholders could do it on their own. And again, that is the crux of the Modigliani-Miller argument. When is it the case that financing decisions can enhance value for a corporation? When and only when the corporation has the ability to make those financing decisions better, or at least more cheaply, than its shareholders could. So this is the crux of the argument, and it's like I said, it's I find it to be a beautiful argument that Modigliani and Miller came up with. It's also very general, and it extends to other contexts. So good. So we have proven what I've called the most important theorem in economics, the Modigliani-Miller theorem. So that's already quite a bit for one video, but let's do more. So now let's start doing a bit of algebra that we can do in the Modigliani-Miller environment. And this is something that's going to be helpful for a number of things. For instance, this is the algebra that we've already applied in the context of DCF. So first of all, let's define a few objects. In the unlevered case, the return on the unlevered corporation, so the unlevered equity of the corporation, is just how much it cost me to buy the entire equity of the unlevered corporation in the denominator. And we're going to, what do we get? So this is the cost of buying the entire equity of the unlevered corporation. And what do I get? I get all the cash flows. It's unlevered. I don't have to share with debt holders. So my return, the unlevered return, put another way, the return on an unlevered investment in a corporation that generates EBIT X in every period, is just this object here. So that's the unlevered equity return. But then, of course, we can compute the levered equity return. What if I take on some debt? Well, on the one hand, I only get, by way of unlevered FCFF, X minus what I have to pay my debt holders every period. So that's what I get. That's the payoff to equity. But at the bottom, that's the cost of equity, which is I only have to buy the equity portion of the firm. I'm no longer financing the debt portion. And so this is the algebra that we did in chapter 1 in the context of mortgage rates. What we find is that the levered equity return, the return on a levered equity investment in this corporation, is equal to the unlevered return plus a premium that depends on the debt to equity ratio. So this is the quantity of leverage that I'm taking on as a corporation, times the gap between the unlevered return and the cost of my debt. And this is the mechanics that we've already looked at on a couple occasions. And what it says is, as long as the cost of my debt is less than the unlevered return, in other words, as long as my debt holders are asking for less than the return on my assets, then as the levered equity return, I get what we call positive leverage. The more leverage I take on, the more I expect the expected return on my levered equity investment to be high. So leverage increases the expected return on my levered equity investment. But of course, there's got to be some sort of compensation in a financial economy, and that compensation, as we've discussed many times, is that risk goes up. So for instance, we've played this game before. If I calculate the variance of my levered equity return under the Modigliani-Miller assumption that debt is risk-free. We have not discussed that assumption yet, but it's an important assumption, and we'll come back to it later. But in Modigliani and Miller, debt is risk-free. This contributes nothing to my variance, so I'm just left with 1 plus DE times the unlevered return. If I do the standard variance math, I see that the variance of my levered equity return is just the variance of my unlevered equity return times 1 plus the leverage ratio squared. We've already done those mathematics. And you remember the intuition for those mathematics. What happens here is I have some debt holders that are extracting a risk-free piece from the corporation, and they just leave the levered investors to hold the bag. So we have the inherent riskiness of my assets. The debt holders are taking out a risk-free piece, and they're leaving me with the riskiest part of the cash flows associated with my assets. Okay, very good. As we've discussed on several occasions, variance is not exactly a useful measure, or at least the most interesting measure of risk. Beta is a much better version. And in particular, we can speak of the beta of my levered equity return. We did the math on the board, I want to say 3 weeks ago, the week before the break, and we found that betas are linear in leverage. So this is our standard delever and relever formula. I will continue to say, or I will repeat, that this formula is only exact as long as my cost of debt, as long as my debt is risk-free, so that this term here drops out of the calculation. And again, the point is more leverage means a higher expected return under positive leverage anyway, for levered equity investors, but it also implies more risk. And why does it imply more risk? It's because the debt holders are taking less risks than I am, and that means I'm left to hold an ever higher quantity of risk as I use more and more leverage. Okay, very good. Now moving on. One of the key objects that Modigliani and Miller introduced in the lexicon of finance is WACC, which is the weighted average cost of capital. So just like the acronym says, it's just an average of the expectations of all my shareholders. And we've done this many times, but I'll just repeat. So here in this case where we only have equity, common equity, and one type of debt, you just take the share of equity in the value of the corporation times the expectation of my equity holders, and then the share of debt times the expectations of my debt holders, and that gives you WACC. And then what Modigliani and Miller give us in that 1958 paper, in addition to the beautiful proof that I just mentioned to you, is what people refer to as Modigliani-Miller proposition 2, which is that WACC is invariant to the leverage ratio. So WACC is the same. The average cost of capital is the same regardless of the quantity of leverage that the corporation uses. And in particular, WACC is equal to the equity return on the unlevered corporation. Why? Because the unlevered corporation has zero debt. So if this is a 0, this here becomes a 1. And then I'm looking at the expected return on the unlevered corporation. So that's the first statement that Modigliani and Miller make about WACC. And the second is that WACC is the right discount rate for unlevered free cash flows to the firm. And it turns out, thankfully, that this is something that is true even when we introduce taxes, but it is certainly true without taxes. Okay, good. So enough chit chat. At this point, what we want to do as usual is illustrate everything that we've said so far with with a numerical example. So we're going to do it at this point. But first, a little bit of algebra. So this is the point where normally in class I would go to the board. And so we're going to prove here the Modigliani and Miller's second proposition. We'll do this quickly. And second, we'll prove this claim that WACC is the right discount rate for unlevered free cash flows to the firm. It's a claim we've used already in our DCF, but we might as well verify that it's correct, at least in the model that Modigliani and Miller have in mind. Okay, good. So let me go to, since I cannot use a blackboard, I'm going to go to those extra notes that are over here. Let me make them bigger. Very good. What am I looking for? Not this guy, not this guy. Okay, so it's section 6 of my notes, which I call WACC usings. And so this is Modigliani and Miller proposition 2. It's something that's quite easy to do. So this is the definition of WACC. WACC is this average of the expectations of all my stakeholders, and all I have to do is replace this expected levered equity return by the expression that we derived a couple slides ago, or at least that we showed a couple slides ago, and that we derived in chapter 1 when we spoke of mortgage rates. So again, the only thing that happens between this first line and this second line is I'm replacing the expected return on levered equity by this expression that we just talked about. And then you just do a little bit of math, and please do this algebra and make sure that it works. So for instance, you can see here that this E, which multiplies this E at the bottom, they cancel one another. So what does that leave us with? That leaves us with E divided by E plus D times E over E of the expected return on unlevered equity plus D divided by E plus D times E over RU. So it's this part here of this expression that comes out. That's E over RU, the expected return on my unlevered equity investment. And then this guy here that's dangling, D divided by E plus D times minus RD, is going to exactly cancel with this guy. Okay, very good. So, but this is just algebra, and that one is very easy. Now, something a little bit more interesting. Let's prove, as Modigliani and Miller do, that WACC is the right discount rate for unlevered FCFF. Now, we're going to do here the case with no taxes, because at this point and today we are still in the world of pure and perfect markets, which implies no taxes. So with no taxes, this argument is trivial. It will become more interesting when we have taxes, but for now we have no taxes. So why is it trivial? Well, by definition, the value of the unlevered corporation is EBIT. So EBIT is unlevered free cash flows to the firm. Why? Because tau is equal to 0 in this case. So 1 minus tau times EBIT is EBIT. And by definition, this is almost the definition of the required return on the unlevered investment. E of RU is the right discount rate for those unlevered cash flows. So we know that this has to be true. You can look at this as a definition of VU. You can look at this as a definition of E of RU. It doesn't matter. That's got to hold for those two objects to have meaning. But what did we prove this morning? We proved that VU is equal to VL. So I get to replace this VU by VL. And a moment ago, with the algebra above, we demonstrated that WACC is equal to E of RU. So I get to replace the E of RU by WACC, and then we get that the value of the levered corporation is EBIT, which once again is unlevered FCFF divided by WACC. So this seems tautological, almost circular, and it kind of is. But the bottom line is, in this world of pure and perfect markets, WACC is the right discount rate for unlevered free cash flows to the firm. Next week, or in our next video, we will show that this is true also for when there are taxes, but for now, we're just doing the case this morning without taxes. Okay, wonderful. So this was the algebra, and hopefully that spoke to you, but if it doesn't, what we're going to do now to conclude this video is like I like to do is we're going to illustrate all of this with Excel. So let's go to Excel and let's move to the context of a specific example. So I'm going to look at a Modigliani-Miller corporation. So what do I mean by that? A Modigliani-Miller corporation is one whose depreciation is equal to investment, whose capital structure is constant, whose debt is a risk-free perpetuity. What else? I'm forgetting. I think I'm forgetting something, but doesn't matter. It will come back to me. Anyway, this is a Modigliani and Miller corporation. So every period, I'm going to assume that EBIT is either low or high. And remember that EBIT is what I've called X on my slides, just like Modigliani and Miller do, but we might as well be explicit here and call it what it is. It is EBIT. So EBIT is either low or high. And to make this specific, I'm going to assume that EBIT is either $50 million every period or $150 million when it happens to be high, and I'm going to assume that the probability that we're going to get the good outcome is 50%. Okay, so far so good. Um, what else do I need? I need the cost of debt, and I'm going to assume, I'm just going to make it specific, that the cost of debt is 8%. And I'm going to assume that the required return on an unlevered in this investment in this corporation is 12%. Okay, so these are basically my inputs, and now I can compute a number of outputs from this. So the first one is going to be easy. It's just going to be my expected EBIT, which is just 50% of the low, and I should put some F4s on this since that's a good habit, even though it's not exactly necessary here. So plus 1 minus P high. So this is the probability of getting the low state. Oh, look what I did. I actually misspoke. So let me do this again. And let me do it correctly and slowly. So there's a probability 1 minus P high that I'm going to get the low outcome. Okay, so this is P low times EBIT when low plus P high 4 times EBIT when high. And of course, that means that my expected EBIT is equal to $100 million. What else can I compute? Well, I can calculate the value of the unlevered corporation. How can I do this? Well, I have my expected EBIT, so it's right here, and I know the required return on that expected EBIT. So what is the return? What is the value of the unlevered corporation? In other words, if I buy this EBIT without any debt, it's got to be my expected EBIT divided by 12%. So this is the value of the unlevered corporation. The value of the unlevered corporation is just my expected EBIT divided by the return that unlevered equity investors require from this type of corporation. Okay. Now, another object that I'm going to compute, and it's very important in my eyes, even though it's very seldom computed in this context, is Dmax. What is Dmax? So Dmax, remember, a Modigliani-Miller assumption is that debt is risk-free, and that's because in pure and perfect markets, it's difficult to deal with the notion of default in any kind of realistic way, put it this way. But anyway, one of their assumption is that debt is risk-free. So what does it mean for debt to be risk-free? It means it's going to be paid no matter what. So, and by the way, I have not, uh, so what does it mean? I'm mumbling now. What does it mean for debt to be paid no matter what? It means that whatever debt I have times 8%, I'm able to meet it even in the worst case scenario in any given period. So what is the maximum debt I can support in this fashion while debt remaining risk-free? It's got to be my worst case scenario, F4, divided by 8%. Okay, so as long as my debt does not exceed $625 million, I am in fact able to pay my debt without any risk in every state of the world, even if I get the low EBIT realization. Okay, so if we want to be strictly speaking in the world of Modigliani and Miller, this is the most debt that we can possibly take on. After that, we've got some questions to ask ourselves that are beyond the strict world of Modigliani and Miller, and we will move, of course, in this chapter beyond the world of Modigliani and Miller, the world in which there is default and the world in which default is extremely costly. Okay, very good. So what are we going to do with this? So let's play and illustrate what Modigliani and Miller are telling us. So I'm going to look at all kinds of possible levels of debt. And of course, I'm going to start from the unlevered case. So that's a level of debt of 0. But I'm also going to look at other levels of debt, and I'm going to do it in increments. So how many increments? So 1, 2, and all the way to how about 20. All right. So how about 20? And of course, the highest amount I'm going to look at is 625. Okay, awesome. So I want to look at various increments of debt. So what does this mean? It means that at step number 2, I'm no longer going to be at 0. I'm going to be at 0 plus an increment, which is the gap between 625, which is the most I'm willing to consider, minus 0, which is the least amount of debt I'm willing to consider, and I had better put some F4s on those guys, and then I'm going to divide by the increment that I want. And of course, it would be tempting to divide by 20, which I'm going to take here, but I forgot to rehearse that part this morning, but my experience tells me that a -1 here is going to do the trick. Why? Because really I only have 19 steps here because I've decided that I start from 0. So I'm only going to add 19 increments, and I want this final number to be 625. So if I start from 0, anyway, those could be famous last words. I may be about to embarrass myself, but it won't be the first time, so it's all good. We're among friends here. The point is that the second level of that is going to be this guy, and then I'm going to click, and if I did this right, the last one is going to, oh, but I don't know because it did not go all the way down. But yes, even if I push it all the way down, 625 it is. So all I've done here, all I have done is I've written 20 equally spaced possible values of debt going from the lowest to the highest. Okay, so now I can write the value of the corporation as a function of my level of debt. And I know, of course, that if I'm unlevered, the value has to be this number here, which we already computed. So that's the value of the unlevered corporation. But I've done so much more today. I know get to do this. I know that changing D cannot impact the value of the corporation. So in fact, this number is going to be equal to the value of the unlevered corporation throughout. Right? That is Modigliani and Miller. The fact that the value of the corporation is totally independent of how much debt I take on. Great. So that's telling me that the value of the equity portion of the corporation, this is just accounting, has to be value of the entire corporation minus the value of my debt. Very good. So this is the value of my equity. Of course, if I'm unlevered, the value of my equity is the value of the entire corporation. And as I go down, the value of my equity is going to go down because all I'm doing is taking on more debt, and the value of the corporation is not changing. Okay, so now let me compute the return that I'm getting, the expected return that I'm getting on my equity. So this is just going to be simple accounting. Remember, there is no tax here. So all that happens is I get the E of EBIT F4, I always get that, but if I happen to have some debt, which is here, I have to pay my debt holders at a rate of 8%. So that's my payoff to equity. And if I want to own that equity, the investment that I have to make is the market value of equity, right? So this is a definition of the levered equity return. We wrote it on, we went over it in one slide this morning. Okay, very good. And I'm just going to click all the way down, and I'm going to format it as percent with 2 decimals because that's what it is. It is a percent. So very good. So what do we see? We see that the expected return on equity obviously goes up as I'm taking on more debt, right? And that's basic leverage mechanics. My debt holders are only requiring 8%. My assets are giving me 12% because that's the unlevered returns is the return on assets of an unlevered corporation. The corporation is giving me 12%. The debt is only costing me 8%. So the more I use debt, the more my expected return on the levered equity portion of the investment goes up. Excellent. So now let's illustrate Modigliani-Miller proposition number 2, and that's going to be equal to WACC. What is WACC? WACC always is equity divided by value of the corporation times the expected return on equity plus debt divided by the value of the corporation times the return on debt. F4, I don't have any taxes to worry about here, so my WACC is as simple as this. And obviously WACC initially, let me format it as percent right away so that we will see what we need to see immediately. Of course, WACC when there is unlevered, when there is no debt, when we're in the unlevered case, WACC is equal to the required return on equity. That's obvious, and that's got to be true. But what Modigliani-Miller proposition 2 says is that WACC is completely invariant to the quantity of debt. That is Modigliani-Miller proposition number 2. So let us plot Modigliani-Miller proposition number 2. So we're going to take my debt levels, the required return on equity, and WACC, and I'm going to plot these guys like so. WACC is the one that does not move. It is the orange line here. And of course, the required return on equity goes up with leverage. And that's because of positive leverage in this situation, right? So why is WACC invariant? So what happens when I take on more debt? On the one hand, I am putting more weight on the lowest source of funds for the corporation. Debt is the lowest source of funds for the corporation. It is risk-free. Nothing is going to have a lower return than this. So it is 8%. So yes, on the one hand, I'm putting more weight on debt and I'm putting less debt on equity, but less weight, I'm sorry, on equity. But the expected return on equity goes up as a result of leverage. And what WACC proposition number 2 tells us, and while qualitatively one can see why that happens, it is not so obvious that those two elements are going to offset one another. What happens is that those two forces do exactly offset one another. On the one hand, as I take on more debt, I am tapping a cheap source of funds, but on the other hand, I am making the expected return and the required return on equity higher as I take on more leverage. And of course, in equilibrium, that comes with the fact that as I take on more debt, my equity payoff, while it becomes higher in expected return, it also becomes riskier. Okay, very good. So this is most of what I wanted to show you today, but let's do one more, just since we have this example that we can play with. So I'm going to calculate E of RE in a different way. So this is going to be a check that some of the things that we've talked about this morning are actually correct. So what's the different way? We're just going to use our leverage mechanics. Our leverage mechanics say that the expected return on my levered equity investment is the unlevered return, F4, plus my leverage ratio, D divided by E, times the gap between my unlevered return and the cost of my debt. And I need to put some F4s on those guys, and I close the parenthesis. Again, I should format those things properly, and if I do click on this, hopefully we're going to finish, and I compute this way of measuring my required return on equity, or this way of measuring my required return on equity, I get exactly the same numbers. Okay, very good. So far, what we've done is we've illustrated Modigliani and Miller, everything that is true about Modigliani and Miller, the fact that value is constant and the fact that WACC is constant as numerically. And now next, and probably in the next video, I'm going to check on time here. We're going to get into the case with taxes. Okay, but let me go back to my slide so that at least I can finish fully the case with no taxes. And so now that we've proved the WACC invariance theorem, we can write an alternative proof of the fact that the value of the corporation is independent of the quantity of debt that is being used. And so that's another proof that you sometimes see written, and it's certainly very, very correct. And the proof goes like this. Under Modigliani-Miller assumptions, cash flows are independent of capital structure. That's another hard-wired assumption of Modigliani-Miller. Regardless of the liability side of the corporation, the debt side, the asset side of the corporation does not change. We're going to start making the case soon that that's not true. In reality, if you're a corporation with a lot of debt, managers are going to tend to behave very differently for a number of fundamental reasons that we're going to discuss. But here we're in pure and perfect markets. There is no moral hazard. Managers behave all beautifully all the time, just like we want them to. So under classical Modigliani and Miller assumptions, firm cash flows are in fact independent of capital structure. And we've proved, and you can prove it also independently of the first Modigliani and Miller proof, that the firm value is the present value of those cash flows at WACC, but then we've shown that WACC is independent of capital structure, so therefore firm value has to be independent of capital structure. So in some sense, Modigliani and Miller proposition 1 and proposition 2 are basically two sides of exactly the same coin. Good. So let's summarize what we've learned from the classical version of Modigliani and Miller. It says that in pure and perfect market, capital structure does not matter. But as I've said already several times in this class, the useful way to read that theorem is to take the contrapositive of essentially the contrapositive of that statement, which says that capital structure does matter because and only because uh, uh, capital markets are not perfect. And put a way that's even more precise. If capital structure matters, it has to be because of the frictions, the specific frictions that Modigliani and Miller assume away. For instance, Modigliani and Miller assume that there are no taxes. Modigliani and Miller assume that there are no costs associated with financial distress. There is no default, no cost associated with it, etc., etc. They also assume, I've already mentioned it, that there are no agency problems, that managers always behave in the best interests of the shareholders, which we know in reality is not the case. Managers have superior information and they have incentives to use that information in ways that maximize their objective rather than the objectives of the shareholder. So really, and this is the bottom line, one needs to think of Modigliani and Miller as a roadmap. It is telling us the specific ways in which capital structure can matter. Capital structure matters only because of the frictions, the few frictions that Modigliani and Miller assume away. Very good. And that's all I will say for today. And I'm going to stop talking.